Hello guys, welcome to today's lesson on intermarket analysis, and today we're going to be talking about the different related asset classes. Now, what a lot of you guys don't know is that you can actually use different asset classes to confirm a bias or a direction or order flow on a specific asset class. Now, a lot of times in my usual market forecast, I usually don't show the behind the scenes of using correlated asset classes to confirm my direction on a particular asset class. And before I go into explaining what how you can use this inner workings of price to confirm price direction on a specific asset class, first off, it is important to understand what the asset classes are. Okay, the entire foreign exchange market is like a merry-go-round. It they're all correlated. Okay, they're all either moving in tandem or they're moving opposite to one another. But it is important that we understand what an asset class is. An asset class simply is an asset in a specific instrument. Okay, so let's go and do the breakdown. You can see we have four major asset classes, and together they make up what we call intermarket analysis, meaning you can use the bias or delivery on one asset class to confirm a bias delivery on another asset class. And you can use one to confirm that of the other, or you can use even multiple to confirm delivery on a specific asset class. So now we're going to define each of these asset classes and its importance into as a tool for understanding market direction as institutional traders. Now, what we're trying to do here is we're trying to map out longer term price delivery. You can also do this on lower time frames too, but without understanding the longer term delivery context, it will be very difficult to understand the lower time frame and to use them as a confirmatory tool. So just like SMT, you can also use intermarket analysis as a confirmatory tool on your buys or your short-term idea, but it is first off necessary to understand the longer-term implications and how they affect the different asset classes. The entire global markets are directly linked to one another, and a lot of people know this. They know that the entire global markets are directly linked to one another, but they don't really understand the correlation or the relationship between these different asset classes. And understanding them all collectively will aid in your long-term analysis of price. So the four major groups when it comes to intermarket analysis is we have the bonds and interest rate, we have commodities, we have stock market or equities, and then we have currencies. Now, majorly, what I use for bond and interest rate are the U.S. Treasuries. You can also use treasuries for German, just German treasuries, just also British pound treasuries or interest rate asset classes you can use. But I don't look at them, and I don't really think they're important in our as a tool in our arsenal for market prognostication. I don't really think they're important. Now you can go and Google them, and you can Google German bonds and British bonds, but it's not going to give you more insight than U.S. Treasury bonds would. Now the reason why is because obviously if you're going to trade British pound, then it's going to move against that of dollar. Okay, so once you figure out what dollar is doing, you can 90% of the time know what pound is going to do, and same for euro. Okay, you can know what euro is going to do by figuring out what dollar is doing, and you can know what the other asset classes are going to do by figuring out what dollar is doing. Why? Because all asset classes are evaluated in terms of United States dollar. Okay, commodities are evaluated against dollar. Currencies are evaluated against dollar. That's how you get the major currencies, right? So there's major currencies. If you go in your M24 or your M25 and you wanted to add a pair to your M24, M25, you would see just majors and then just minors. So the majors are the currencies that are paired against dollar, and then the minors are currencies that are a derivative of the majors, aka two majors paired together creates a minor. So I'm just breaking this down. It really is basic forex logic, but you get GBP US dollar and Aussie US dollar as the two major pairs, okay? And these are the two major pairs, which is cable, GBP US dollar, and Aussie, Australian dollar, United States dollar. And the derivative of both of them would be GBP Aussie as a minor, and this is how you get your cross pairs, okay? So minors are usually derivatives of major pairs or major currencies, and this is how you get your cross pair. So by understanding the delivery on pound and also understanding delivery on Aussie, you can use that to forecast with high efficiency the delivery on pound Aussie. So let's say, for example, dollar is consolidating and we are seeing pound Aussie consolidate, but Aussie United States dollar is strongly rallying. What does that mean? It means, again, our reference pair here is dollar. If dollar is consolidating, ideally we want to see all the majors consolidate because dollar is consolidating. But if we see pound consolidated against dollar, which is showing, correlation supposed to, but we see Aussie rallying strongly against dollar, that shows Aussie has extreme strength against dollar, but pound does not. Because if pound had extreme strength against dollar, it should also rally, but it's not rallying. Instead, it is consolidating. So if we use that to a cross pair, since we can see that pound Aussie is neutral, let me use an arrow tool. If we can see that pound Aussie is neutral and Aussie dollar is rallying, okay, that means we have strength in Aussie, we have neutrality on pound. So if we went and we did our minor or our cross pair, which is pound Aussie, then we should see ideally weakness because we have a neutral pound and we have a strongly rallying Aussie. So that should lead into weakness of pound against Aussie, and thus we can anticipate, just by looking at two majors, which is pound and Aussie, we can anticipate the directional premise of pound Aussie, which is a minor. Okay, so that was just a little bit of segue into the inner workings of price against dollar. But majority of the assets are all valuated relative to dollar. Okay, the commodities are valuated relative to dollar. Gold is valuated relative to dollar. Silver is also valuated relative to dollar. Other commodities, not only metals. So in commodities we have different groups. Okay, we have the metals, which involves copper, platinum, gold, silver. We have grains. So actually, if we go to barchart.com, we can see the different asset classes. We have grains. So if we go to select commodity on the futures, so barchart.com simply displays futures for each asset class. Here you can see we have wheat, corn, soybeans, soybean meal, oats, rough rice, and these are all grains and oil seeds, and they all fall under commodities. Okay, they're all commodities. So there are different instrument types inside of commodities. Okay, so the grain and oil seeds, energies, crude oil, natural gas, ethanol. Okay, there are energies. They have their own group under commodities. And then we have the metals. We have gold, silver, hydro copper, platinum, palladium, aluminium. Okay, these are all industrially or commercially traded commodities, and they are on the metals inside of the commodity asset class. And then we have livestock. We have live cattle, feeder cattle, pork, dry weight. These are things that are also commercially traded, and they still fall under commodities. And then we have soft like cotton, oranges, coffee, sugar, cocoa, lumber. they all fall under commodities. So under commodities, we have different asset groups like soft, livestock and dairy, metals, energies, and grains and oilseeds, and they are all commodities. Okay, that's one asset class. And then another asset class, bonds and interest rate. You can see we have I only use U.S. Treasuries, okay, for bonds and interest rates. So if you go here, which is financials, you can see we have the Treasury bond, we have the 10-year Treasury note, 5-year Treasury note, 2-year Treasury note. So what I use typically is the Treasury bond. With this Treasury bond here, that's the 30-year Treasury bond. And then we have the 10-year T-note, and then we have the 5-year T-note, and I don't use the 2-year T-note because it's not really necessary. Okay, what I'm looking for is I'm looking for a longer term to intermediate term or short term order flow. So the 30-year Treasury bond gives you a long-term macro. I was not supposed to. The 30-year Treasury bond gives you longer-term macro on the 30-year U.S. Treasuries or on the United States Treasuries. So let me just break this down real quick. And I know it's a little bit of a complex topic, and I'm going to try my best to break everything down. Now remember, we have 4 asset classes. We have bonds and interest rates, we have currencies, we have commodities, which is talked about, and then we have stock market or equities. Okay, so in commodities, we have the different asset groups under commodities, which is what I broke down. You have grains and oilseeds, you have metals, you have energies, you have your soft, and you have your dairy. Okay, they're all different asset groups under commodities, and inside of those asset groups, then we have each asset. Like under metals, you have gold and silver. And, under grains and oilseeds, you've got wheat, you've got oats. Okay, and all of that stuff under commodities. Now under bonds and interest rates, I focus specifically on United States Treasuries. So you call them U.S. Treasuries. Okay, or U.S. T-bonds. So T-bond simply stands for Treasury bonds. So you can interchange the terms. You can call them United States Treasuries or United States bonds. They're all the same. Okay. Now let's understand the difference between United States Treasuries and interest rate, because interest rate and treasuries, they are correlated. You can see here it says bonds and interest rates. Interest rate and treasuries are correlated. Okay. If we are seeing a rally on treasuries, that means a decline in yield, because there is an opposite correlation between treasuries and yield. I'm not sure if we're going to talk about this in the course. Okay, it's supposed to be one of the topics in the course, correlation between treasuries and yield. And I think I'll do a separate video just to break down in detail the relationship between treasuries and yield or interest rate. Okay, so interest rate also means yield. Also means yield. And I'm trying to see if I can, so let's actually go to the course and try to find the PDF. Okay, so what I'm trying to look for is if there's a topic in this where I go in detail into interest rate and yield. Okay, interest rates, that was supposed to be something I talked about, but I'm not sure I talked about that in detail. So I think actually on the video we're going to discuss this more in depth. So before I go into the other parts of this video, we're going to have to talk about treasuries and yield. Okay, because it's going to be a really important part of our analysis. So just a little bit of a segue. It might be more of like a 20-30 minute segue, but it's going to be very valuable in terms of understanding treasuries and yield. Alright, so now let's talk about what treasuries or bonds are. So not even talking about US treasuries or bonds. Let's discuss what treasuries or bonds are. Okay, a bond is simply an IOU issued by an entity when it needs to borrow money. Okay, so what do I mean by an IOU? Simply, okay, remember what currencies are. I think I've read a book before, and prior to 1970, when Nixon removed a dollar off of being backed by gold, um, when the government issued a currency, that was usually an IOU by the bank. So not the government. When a bank issued a currency note previously before used to mean the equivalent worth of dollar in the reserve. Okay, that when dollar was actually tied to gold. Okay. Now, what they use currently is what they call fractional reserve banking, and that's something you can go Google. I don't want to go into that in detail because that's just going to be like an hour segue. Okay, which means essentially the currency note you're using is just simply backed by thin air, backed by the bank, with no real asset to back that currency note. Okay, now a bond simply is an IOU issued by an entity when it needs to borrow money. For example, a government or a municipality, like a state government, a federal government, or multinational companies that require lots of funds to operate. Okay, they issue that, and they in turn get an IOU, meaning they issue. It's more like a trust per se, something like that. Okay, so when they issue the IOU, it's more like a trust because they need money for function or to perform an operation, for example. So when you own a government bond, when you as an entity, as a person, or if you have a company and you buy or purchase a treasury or a government bond, a treasury essentially is a government bond, it means the government has borrowed money from you with a guarantee in a specific time period that you've agreed when you purchase that bond to return back to you. Now, unlike stocks, bonds have a defined term to maturity where the owner gets paid back the money he loaned, which is known as the principal, okay, at a predetermined set date. Okay, so it could be 2 year treasury. So a 2 year treasury means the defined term for that treasury for maturity is 2 years. Okay, a 5 year treasury means the defined term for that maturity of that treasury is 5 years. And a 10 year treasury simply means the defined term for maturity for that treasury is 10 years. Okay, so you cannot access the fund because you've lent the money to the municipality or the government that issued the bond. So this is how it works. So let me just break this down. All the terms I use and everything. Okay, let me just break this down so you understand what I mean. Let's define bonds. Again, remember, bonds are treasuries. They're interchangeable terms. Okay, so we're gonna call this bonds or treasuries. Okay, they're all interchangeable terms. It is an IOU issued by an entity, e.g., government or a municipality. Okay. As a So, for example, if you are buying a US 10-year treasury bond, you're essentially buying an IOU, a promise by the United States government that within 10 years we are going to give you back your principal because we require this money. We're going to give you back your principal plus a yield. So treasuries usually have a specific yield. Okay, it could be 5%. So 5% yield simply means the rate of return on that yield. So let's say you bought 100K worth of United States Treasury, okay, and The term for maturity of that treasury is 5 years. Okay, so that means in 5 years, if the yield on that treasury is 5%, you're getting $5,000 extra on that 100K worth of yield you purchased. So in total, you're getting 105K in 5 years from the 100K worth of 5-year treasury bond you purchased from the United States government. Okay, so because they're all interlinked, okay, they all correlated together, and it will make sense. So a bond or treasury is an IOU issued by an entity. Usually it's the government. Okay, sometimes multinationals can also issue bonds, so there are private bonds, but mostly the government, okay, issues bonds, okay, as a guarantee or requiring funds to operate. Meaning, it's just like taking loan from a bank. If you are, as a citizen, or if you as a person, individual, if you're going to take a loan from a bank, right, you obviously need a collateral. Okay, you're going to need a collateral to take loans from the bank because you want to do something like a business. You want to do something. Okay, usually it's when you want to do a business, then you're going to the bank to take a loan. Now, what the government do in situations like this is they issue an IOU, meaning a guarantee, because they are the government. So they're giving you a guarantee because they are the government that, okay, in 5 years from now, okay, we're going to get money from you to use to do government stuff, okay, and then in 5 years from now, we're going to give you back your principal plus the yield. And now let's talk about the yield. What's the yield or interest rate? So interest rate or yield, they are the same thing, just like bonds and treasuries are the same thing. Okay, interest and yield are the same thing, and this simply is the rate of return on a bond or treasury. Okay, so if the interest rate is 5% and the term for maturity of that bond is 10 years, meaning at the end of that term, you're getting 5% on your, treasuries. If the interest rate is 20% on your treasuries, okay, and the rate of the term for maturity is 30 years, okay, then you are getting essentially 20% on your treasuries. That's what it is. Okay, so that simply is the interest paid to you by a bondholder along with your principal. And a bond price, again, I know these are all boring topics, so you can skip forward if you don't like this part, if it's not interesting to you. And I've mentioned before, I said these topics are really boring. So when I was going through them, it was extremely boring for me, but it's helped my understanding of intermarket analysis when trading. A bond price simply is the amount. Bond price simply is the amount a bondholder pays to purchase a bond. Okay, so the yield and interest rate is the rate of return on a bond, and the bond price is the amount you're paying to purchase or own a bond. Now, the correlation between this is, the correlation between the yield or interest rate and the bond price is that they are oppositely correlated. Okay, so it is an opposite correlation, and it's something like this. Let me squint this up a little bit. Okay. Here we have bond yield or interest rates, and here we have bond price. So we're going to discuss all of this. So to our left of our chart, we have our yield or interest rate, and to the bottom of our chart, we have the bond price. So as we see a decrease in the value of the interest rate, we typically are going to see an increase in the price of the bond. Okay, that's the correlation. If yield is decreasing, bond price is increasing. If bond price is decreasing, yield is increasing. Okay? As we see an increase in bond price, usually, I think that was the wrong chart. As we see an increase in bond price, usually yield is decreasing. So, as bond price increases, again, the relationship, they're oppositely correlated. As the value to purchase a bond increases, then the rate of return on that bond will decrease. And if the rate of return increases, then the value or the monetary value required to purchase a bond decreases. That's usually the way it goes. So thus there's an inverse correlation between bond prices and yield. So if interest rates are rising, then bond yields will rise and bond prices will fall. And the US bond yield gauges the performance of the United States stock market or equities, and that's the relationship. So we're starting to get into the relationship. It's how everything all ties back together. But before I went into that relationship, it was essential that I broke down what treasuries are. Okay, treasuries are IOUs issued by a government, municipality, or it could be a multinational as a guarantee when they require funds to operate. Okay, that's what a treasury is. And a yield is simply the rate of return on a bond. And the bond price simply is the amount required to purchase a bond. Now, the higher the amount required to purchase a bond, the lower the rate of return on that bond. The lower the rate of return, or the higher the rate of return on the bond, then the lower the price of the bond. That's the relationship. Now, the U.S. Treasuries controls or gauges the performance of the United States stock market. Okay, why? Remember, okay, for you to purchase a bond, you require the currency of that bond that it is valuated in to purchase that. So let's say, for example, you wanted to purchase German bonds, then you require euro to purchase German bonds, because again, German bonds are valuated in euro. If you wanted to purchase British bonds, then you require pound to purchase British bond, because again, British bonds are valuated in the currency of that country. So for you to purchase a bond, you're going to have to purchase the currency that the bond is valuated in. So if you wanted to purchase yen bonds, then you're going to have to purchase Japanese yen, because again, the yen bonds are from the Japanese government. So you're not going to allow you to purchase your bonds in United States dollar. You're going to have to purchase your bonds in their own currency. Same thing with United States Treasuries. If you're going to purchase United States Treasuries, then you're going to have to purchase dollar to purchase United States Treasuries. Sir. So what does that mean? That means for you to buy bonds, then you have to purchase the currency that the bond is valuated in, which means the higher the bond price, or the increase in bond price, the increase in the value of the currency. Why? Well, let's explain why. Let's explain this from a fundamental perspective. The reason why is because a lot of investors look at bond prices as safe haven assets. Okay, they are safe haven investments. There's a guarantee because it's coming from the government. So there's a guarantee return on your investment. Now, if you went to invest in risky assets like hedge funds and everything, they might offer higher returns, but it's not guaranteed. It's not a guaranteed return because, again, it's private. But if you're purchasing government bonds, then there's a guaranteed return because it's coming from the government. So if you're thinking, why would someone go and purchase? Why is it that when the bond price is increasing? Because I also had the same question too. years ago when I was learning all of this, why would the bond price be increasing and the yield or interest rate be decreasing? Usually this happens during high risk market conditions. Okay, what I call risk averse conditions. So during periods of like COVID, for example, war, uncertainty in the global economic scale, a lot of investors globally will flock to what I call safe haven assets. United States treasuries, the dollar, which is the world reserve currency. They'll flock into assets like that. So if they're purchasing United States government bond, then they need to purchase dollar to be able to purchase the bond. So if they're going to purchase dollar, what does that mean? It means an increase in demand for dollar. An increase in demand for dollar will lead to increased value per dollar because there's an increased demand for dollar. Why are they purchasing dollar? So they can then buy government bonds. What will that lead to? The more the demand for a specific bond, the higher the prices increase. Right? It's basic economics, basic supply and demand. Again, I'm not saying the market is controlled by supply and demand factors, but we're talking about fundamentals. Why do currencies rally fundamentally? This is why. You're all correlated. You're all interlinked. Okay? So, if there's a high demand for government bonds, that will lead to higher prices on the bond price, and that will lead to higher prices for the currency associated with that bond price. And that will lead to a lower interest rate. Now, the reason why interest rate the reason why a government will offer higher interest rate is to attract investors. So if they're offering higher interest rate to attract investors, then that means bond prices are going to be lower. Right? Because high interest rate means you want more people to purchase your bond because you need money. Okay? And that means you have to reduce the price to purchase that bond. Because if you increase the price, then essentially you're shying away investors from purchasing your bond. So that's why this correlation exists. Higher the rate, okay, lower the bond price. And if there is lots of investors flocking into your treasuries, wanting to purchase your treasuries because you're looking for safe haven investment, okay, that's going to lead to an increase in the bond price, which will lead to a decrease in the interest rate or the rate of return. Because they're purchasing this not just for the rate of return, but for the safety of the investment. That's why you're purchasing this. So their primary goal is safety of investment. Okay? And that's why the rate or interest rate does not increase, rather it decreases because there's a higher demand for that bond price. They're guaranteed a return. It's more like a guarantee. Okay? If I told you, borrow me $100,000 and I'll give you 10% in 2 years' time. As the United States government told you, borrow me $100,000 and I'll give you 1% in 2 years' time. Who would you give your money to? Now, you might say, you want to give your money to me because I'm offering a high return. But what is the guarantee I can pay back your initial capital you lent me plus the 2% I'm promising you? Just not a lot of guarantee. But what's the guarantee that the government can provide that capital plus your interest? There's a lot of guarantee. So who would you want to give your money to? If you wanted your money to be safe, and if you're looking for a low risk investment, who do you want to give your money to? Obviously, it's going to be the government, because even though you're offering a lesser return than myself, they have a higher guarantee due to them being the government. So that's the way it works. Okay, and also remember, multinationals can also offer bonds. Okay, because again, usually if they require money for some certain investment, then due to, if Apple is offering a bond, I'm using Apple as an example. Okay, Apple is $1 trillion company. If you're offering a bond and I'm offering a bond, who are you going to listen to? Or I'm offering, my hedge fund says, you can do this amount of money, but you're looking for a safer investment. Who would you be willing to invest your money into? Is it going to be me and my solo company, hedge fund company, or is it going to be Apple, which is $1 trillion company? Obviously, it's going to be Apple because you have the guarantee that they can pay back your investment plus, the rate of return. Okay, so that's how it works. So that means from this relationship I just gave you, that means if we are seeing higher bond price, let's do it this way. Bond prices higher. If there's an increased demand for bonds, treasury bonds, there's going to be an increase in the bond price. So if we are seeing higher bond price, that will lead to the interest rate going lower. Okay, that will lead to lower interest rate or yield. You can call it interest rate yield, but we're going to call it interest rate. So if we're seeing higher bond price, that will lead to lower interest rate, and that will lead to higher currency prices. Okay, the currency for that specific treasury will go higher. Why? Because if you're going to purchase the bonds, then you need to first purchase the currency, then purchase the bond. So the relationship between the bond price and currency is positively correlated, and then the relationship between the interest rate and currency is negatively correlated. Okay, so if we see a decrease in interest rate, that will lead to an increase in currency. Okay, if we see an increase in bond price, that will lead to an increase in currency. So that means for the U.S. Treasuries, so that's for the 30-year Treasury bond, which measures the long-term scale. Okay, so let's do this. These are the Treasury bond we use. So we use 30-year Treasuries. Okay, ZB. Sorry. Ten-year Treasuries. The code for this. So if you're wondering what ZB is, that simply is a code for 30-year Treasuries, and ZN. Sorry, this was not supposed to be ZB. ZN is the code for 10-year Treasuries. This measures intermediate term bond prices. And then the 5-year, and these are the treasuries you need for your intermarket analysis. CF. This measures short-term bond prices. So the 30-year treasuries measures longer-term bond prices, 10-year measures intermediate-term bond prices, and 5-year measures short-term bond prices. But usually they all move in sync. They are all correlated. Okay, if 30 years going higher, 10 years going to go higher, 5 years going to go higher. If 30 years going lower, or if 5 years going lower, 10 is going to go lower, 30 is also going to go lower. And you can use SMT to verify turning points in these asset classes, just like you would for GBP US dollar and your US dollar using SMT. I've taught you what SMT is, which is just essentially divergence. Just the same way you would use them to confirm a swing high or low on your dollar versus cable, or underlying versus reference, which I taught you guys. You can use them on the same treasuries because you're all correlated. And once you can understand what the treasuries are doing, a lot of times that gives you an insight into all the other asset classes, which is currencies, which is equities, which is also commodities, because you're all correlated together. Now let's discuss the correlation. Okay, we've broken down what bond are, what yield is. Let's discuss the correlation between the different asset classes. Okay, just to revisit, we have 4 major asset classes. We have bonds and interest rates. Okay, we have commodities, we have stock market or equities, and then we have currencies. Now let's talk about bonds and interest rate. I already explained the relationship between bonds and currencies. Okay, if bonds are rallying, currencies will rally. All right. So if U.S. Treasury bonds are rallying, that means dollar is supposed to rally or decline. What's it supposed to do? If U.S. Treasury bonds are rallying, if the bond prices are rallying, what is dollar supposed to do? Dollar is supposed to decline. Let's see. Here, you can see between March 8th to 14th of April, we had a decline on dollar. If we pulled up the 30-year interest rate, which is ZB, That's US Treasury bond futures. You can see while dollar was declining, it was rallying. Decline here, rally there. If you do the same thing with the 10-year, when dollar is declining, bond prices are rallying. And I think actually, let's just quickly revisit. Let me cancel this real quick. Let's use a plain chart, and I think this is probably a very long session. I was thinking it was gonna be more like I was thinking it was gonna be around like a couple minutes lesson, but again, without a time frame, it is very, very complex, and it's essential that you guys understand when I'm communicating. So let's revisit one more time the relationship between bond prices, yield, currencies. We have bond prices here. We have yield or interest rate here. And then we have currency here. Okay, so I wanted to correct something I talked about in the last couple minutes. Okay, and this is to clarify. If bond prices are rallying, interest rate will be declining, and currency should decline. Okay, so I made a mistake. I want to start the video all over again because I made a mistake on a small part of this video. Okay, so if bond prices are rallying, then yield or interest rate should be declining, and the currency should also be declining. Now, the reason why people purchase bond prices is for safety of investment. Okay, that's the main reason why they purchase bond prices. But now let's do this instead. Let's say the Australian government. The Australian government is offering you 5% return on their 10-year T-bonds. Okay, T-bonds is treasuries. If the Australian government is offering you 5% on the 10-year T-bonds, and the US government is offering you 1% on their 10-year T-bond, as an investor, who would you go and whose treasuries would you be buying from? Because you're guaranteed your 5% because it's coming from the Australian government. You also guarantee your 1% because it's coming from the United States government. So whose bonds would you be purchasing? Obviously, you're going to be purchasing that of the Australian government because they have a higher rate on their treasuries. Okay? And the US government has a lower rate on their treasuries. So that will lead to an increase in demand for that treasury. An increase in demand for the treasury means there's going to be an increase in there's going to be an increase in demand for the currency because again, the Australian government treasury bond is evaluated in Aussie dollar. That's the currency you need to purchase your government bond. Again, it's a government bond. So you're not going to require a different country's currency to buy their own bonds. Okay, they require their currency. Okay, so that's going to lead to an increase in demand for the currency. So if that's going to lead to an increase in demand for the currency, that will lead to increase currency because this has a higher interest rate. Okay, so that's the correlation. And because this has a higher interest rate, then and the correlation between interest rate and bond prices is opposite, that will lead to lower bond prices. So that was what I wanted to correct. Okay, so this is the correction. I made a mistake in the initial example. I actually got them mixed up, and this is the correction. Okay, if bond prices are declining, yield or interest rate would be rallying. If yield or interest rate is going to be rallying, investors will flock to higher interest rate, which will lead to increased demand for that currency, and then you have higher currency prices. Okay, so lower bond prices means higher interest rate and higher currencies. Higher bond prices means lower interest rate and lower currency, because of the correlation between currency and interest rate, and the correlation between interest rate and bond prices. Okay, so bond prices is oppositely correlated to interest rate, which is oppositely correlated to currency. Okay, so that's what I wanted to explain. Now, if we go back on dollar, ZB is 30-year or longer term measurement for 30-year treasuries. ZN is intermediate term measurement for 10-year treasuries, or for United States treasuries, and ZF is short-term measurement for United States treasuries, which is a 5-year period. Okay, so we have this. These are the three main treasuries I use, and you don't need any other one because you're already tracking long-term. You're tracking long-term movement on the treasuries. You're tracking intermediate-term movement on treasuries. You're also tracking short-term movement on the treasuries. So that gives you a whole holistic view on United States treasuries. Okay, now if we are seeing higher prices on the treasury, because usually they'll do the same thing. If 10 years move higher, both 5-year and 30-year will also move higher. Okay, so now if we're seeing higher prices on the treasuries using the correlation I taught you just now, which we revisited and revised, right, that will lead to lower yield or lower interest rate. And what does that mean for currency? That's going to mean lower value for that currency, because there's less demand for that currency, since there's less demand for the government bond due to lower yield or lower interest rate. Why would I want to purchase your government bond if there's another country offering a higher rate on the government bond? I would not. So that leads to lower demand for that bond. And lower demand for the bond means higher bond prices, lower yield, and lower demand for the currency, right? So if we are seeing lower bond prices, that means higher interest rate and higher currency. So that's the correlation, or that's the relationship. Okay, so going into this, if we are seeing bonds decline, that means interest rate should rally. If interest rate is rallying, that means currency should rally. If currency is rallying, aka dollar, because we're using United States interest rates or United States treasuries. Okay, so if U.S. treasuries are declining, that means dollar should be rallying. If dollar is rallying, what's that going to mean for commodities? That means commodities should be declining because commodities are valuated in dollar. Okay, that should also mean equities should be, what should we be doing? If treasuries are moving higher, meaning higher treasury prices, equities are going to be moving higher too, because you're positively correlated with treasuries, because they are valuated in dollar. Hopefully that makes sense. The equity market is valuated in dollar. What's the S&P market valuated in? It's amount relative to the dollar. What's the Nasdaq market valuated in? Its value is relative to the dollar. So any asset whose value is relative to the dollar is going to move opposite to the dollar. That's why commodities move opposite to the dollar, because they're valuated against dollar, or their value is measured against dollar, if that makes sense. So if we're seeing lower prices in dollar, that should mean we should generally see higher prices. Not every time, but generally. Okay, we're generalizing here. That means we see higher prices in commodities, higher prices in equities, and higher prices in treasuries, and lower prices in interest rates. Okay, so that's the relationship. And I think that should sort out into market analysis. So just to revisit before I close out the session, we have 4 major asset classes. We have bonds or interest rates, we have commodities, we have currencies, and we have, I think, what's the last one? Equities, stock market. Okay. If bonds are moving higher, that means currency should move again for that asset lower. Commodities should move for that asset, or let's do it this way. Let's make it easier. If U.S. treasuries are moving higher, okay, because that's what we're primarily concerned with. We're not dealing with German treasuries or pound treasuries because U.S. is the reserve currency for the world. So if U.S. treasuries are moving higher, what does that mean for the interest rate? They're oppositely correlated, so interest rates are moving lower. Okay, so if treasury bonds, United States treasury bonds are moving higher, that means dollar is going to move. Is it going to move higher? Or is it going to move lower? If treasury bonds are moving higher, dollar is going to move lower. Okay, because the correlation between bonds and interest rate is that if bonds are going higher, interest has to go lower, and then the currency associated with that bond has to also go lower. So let's do it this way. Okay, let's do the final recap. And I'm probably sure this is not one of my better lessons because of me having to update mid call, but let's do it this way. Okay, ZB, ZN, ZF, which stands for 30-year treasuries, 10-year treasuries, 5-year treasuries. We have them on one end. We have DXY on the other end. We have GBP US dollar on one end. We have Euro US dollar on the other end. We have Aussie US dollar on the other end. We have US CAD on one end. We have grains. We have gold. We have silver. So I'm just going to list all the asset classes. Okay, so let's see if we can fit all of this here. Let's go to other asset classes. We have oil. Let's do US oil. We have S&P. Yes. Let's do it this way. ES is S and P 500. YM is Dow. Okay. Or US 30. Okay. YM is Dow or US 30. And these are all equities. ES, YM, NQ. They're all United States equities. This is NASDAQ. So we're doing the delineation among all the other pairs. Alright, so if US treasuries are going higher, GBP dollar should be going higher. Euro dollar should be going higher. Aussie should be going higher. US CAD should be going lower. Grains, okay, should be going higher. Gold, higher. Silver, higher. NASDAQ, higher. Dow, higher. ES, higher. Oil, higher. Dollar, lower. This is the USJPY. There's some extra ones. Okay. USDJPY should be going lower. This asset class is treasuries or interest rate for United States, currencies, commodity, equity, 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 currency, 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 commodity, commodity, commodity. Now, what I use for my intermarket analysis, I usually use interest rate, United States interest rate, and commodities, which is gold, just gold and silver. I don't necessarily look at oil. I don't look at equity market because once I know what gold and silver is doing and treasuries are doing, then I can get a very clear insight into what dollar is doing. Now, usually when I'll use this, when I'll go and look at commodities, is when my bias is not really clear on dollar. So if I cannot define or discern with clarity what order flow is, then I'll go and take a look at correlated asset or a different asset class like gold and silver and commodities. Sorry, and treasuries. Okay, so I'll look at commodities, which is gold and silver. I don't usually look at grains or the other ones I mentioned. So I look at all these other commodities like platinum. You don't need them. Okay, so once you know what gold is doing, they already have an insight into what commodities are doing. Okay, so I usually use gold, and I use silver just to look for SMT on gold to confirm if it aligns with my dollar bias, and I'll use the treasuries market. Okay, but usually when I'm looking at dollar, I usually use treasuries market to define my bias. Excuse me. I don't trade equities, so I don't look at them at all. I usually sparingly will look at equities because I don't really need them if I know what treasuries are doing. Okay, and once I have an idea of what treasuries are doing and what dollars doing, I already know what all of the currencies are going to do. Okay, so I don't need to look at this to know what currency is going to do. Once I know what treasuries are doing, all I'm trying to figure out is, are we in risk on market or risk off market? So risk on market means dollar is bearish, and risk off market means dollar is bullish. That's what I'm trying to define. I'm trying to define if we are risk on or risk off. Risk on versus risk off. Okay, that's what I'm trying to figure out. So when it is risk on market, that means dollar is bearish, okay, and our safe haven asset is declining. When it is risk off market, that means dollar is bullish and our safe haven asset is rallying. That's what I'm trying to figure out, and that's why sometimes if I don't have a very strong opinion on dollar using the interest rate market, I'll go and look at the commodities market for extra confirmation. And if I cannot get that extra confirmation commodities market, then it probably is very low probability for me, and I'll just stay out. I don't need to force anything. I'll step aside because I know my written price is not really clear, and I'll wait until I can get very clear confirmation price. Okay, so this is the lesson on intermarket analysis, and I'll see you on the next one. Trade safe.